This is Alan Farley from FX Empire. Please subscribe to the FX Empire YouTube channel. Backwardation of commodities hit nearly a 15-year high this week as suppliers struggled to overcome supply disruptions as a result of the pandemic. Now, what is backwardation? Simply stated, in backwardation, the spot price of a commodity is higher than the futures price of a commodity. Now, of course, there's only one spot price, but there's many futures prices depending on the length of the contract. Now, in backwardation, you get a down-sloping futures curve. Down-sloping meaning that the spot price is the highest price, and then each successively forward futures contract, whether it's monthly or quarterly, has a lower price, creating a downward slope. Now, this condition is considered to be temporary because futures traders are betting that long-term pricing will be lower than short-term pricing, say on copper or soybeans. However, sometimes backwardation can indicate a market stressor that is semi-permanent in nature. In other words, a shift in the supply-demand equation that will produce far-reaching changes over time. I think we saw this around 2003 to 2005 with metals when China was taking off on their infrastructure building and metals started to go crazy. Now, again, we're coming out of the pandemic, so there's a good reason for spot prices to be higher than longer-term prices. We have bottlenecks in production all over the place, as you can see in chips in semiconductors, but also a lot of other raw materials are being affected by the disruption as a result of the pandemic. Now, let's take a look at an example of backwardation with the copper's market. Now, what I have here is, let me count them, 1, 2, 3, 4, 5. COMEX E-mini future copper futures, starting with the current contract, and this is the May contract going all the way down. I think this is May, June, July, and then I skipped a few, maybe from September to December, to give you an idea of what this looks like. Now, I'm also using percentage change over time instead of absolute price, because when you're dealing with copper, you're dealing with fractions of a penny sometimes, and it doesn't really show up very well. In fact, I'll show you. See, if you try to do exact prices, it looks very close together. But as you can see, when you spread it out for percentage change, that the current price here is higher and producing a much stronger rally than, say, the December contract, which is this purple thing down here. Now, this is very important, as you can see, backwardation has been in force for quite a time now. It's been leading the futures higher all the way up to right now. We're at I believe, a multi-year high, like a 7 or 8 year high. And so what you see, this space right here is backwardation. You see how this is all like a rainbow, all sandwiched from the shorter term future. And this is, I think, June again, July, probably September, and then December. And so we have here is an 83% change over, I believe, a 12-month period. Or actually, it's measuring from back here, which is what, May of 2020. So very close to 12 months. It's risen 83%, the December contract, over that period of time, while the spot price, which is it's a futures price here, but this is the May contract. It's going to be expiring soon. Has risen 89% over this period. Now, this 6% is a difference. It doesn't seem like a big difference, but it is a big difference, and it's creating backwardation. Now, you'd see the exact opposite in contango, where the blue line would be under all the other lines, and it just flip over into the reverse, and that's called contango. And contango is when the futures curve is rising, and it's kind of a normal situation, because the spot price is at one price. And if you're in a bullish market, as the future goes on, you're going to get inflation, and the inflation is going to overcome the carrying and storage costs of the futures at some point, and create this upward curve, so that if you're looking at if it's May and you're looking at December contract, you're going to expect to pay more for copper in December than you will in May. But we're in exactly the opposite now. Now, theoretically, this is going to change very shortly, because the traders are going to catch up with this by arbitraging between the longer and the shorter dated contracts, which means they're going to sell short. They're going to sell short the highest one and try to buy it back at the lowest price. Now, this theoretically is going to eliminate backwardation at some point, so we move it to stasis or even back into contango. But if we're at the say the cusp of a big metals bubble or a big commodities bubble, then there's a possibility that we could go crazy and that backwardation could be much, much higher than longer dated contracts.